Hello, my name is Brianna Batieste, and I am going to be covering a DuPont Research Analysis and Report for Delta Apparel and for KBS Fashion for Finance 301, Section 1, Spring of 2019. This report is going to be conducting an analysis on a comparison between Delta Apparel and KBS Fashion. We're going to be looking over the financial statements for 5 years worth of data for Delta and KBS Fashion, which are in the same industry of merchant, retailing, and clothing and apparel. So first we'll be covering liquidity ratios. And under liquidity ratios, we have the current ratio for Delta Apparel. We have the current ratio for KBS Fashion. The formula for current ratios is current assets divided by current liabilities. And when you conduct that calculation, it's going to give you the data that you need for the current ratio of each and every single company. So for 2018 through 2014, I have a current ratio that ranges from around almost 3 to a little under 3 at 2.97 to 2.67 from 2018 to 2014 for Delta Apparel. And for the current ratio for KBS Fashion, it is 5.54 for 2018, and then it ranges to 4.7. So this has shown a trend that has appeared from 2014 to 2018, where they have both increased over time with their current ratios. And the industry average that is compared to the current ratio is 1.76. So both corporations are actually operating above the current ratio average for that industry. And then we're going to move on to the quick ratio. The quick ratio is the current assets minus inventories divided by the current liabilities. And from 2018 to 2015, we have a range of 0.6 to 0.9. So it has decreased over time from 2014 to 2018. And that's for Delta Apparel. And for KBS Fashion, the ratios are a lot higher, but they have instead increased over time for their quick ratio, or also known as the acid test. And their industry average was 0.72. So the ratio for Delta Apparel was a little bit closer to that, but for KBS Fashion it wasn't. And then we're going to move on to the cash ratio. The formula for the cash ratio is cash divided by current liabilities, and they have operated below zero for Delta Apparel. Their cash flow has not been as productive as KBS, which has increased over time at a range from 2 to 3. In this next portion, I have created graphs to depict and reflect the current ratio, cash ratio, and quick ratio for Delta versus KBS Fashion. So starting with the current ratio, you can see that the trend has operated above all of the other averages. For KBS, their average was actually kind of more steady, and then it declined as time decreased. And for the industry average, it was just, of course, straight across the board. For the cash ratio, it was operating well above the average for DLA. KBS has a better cash ratio than DLA, so theirs is way higher. And in the quick ratio, KBS has kind of been a little bit steady, but then they had this major drop and then they shot back up, whereas DLA has been a little bit more steady over time. And the breakdown for all of this is ranging from 2018 to 2014, and the industry averages were a little bit closer for DLA, Delta Apparel, than they were for KBS Fashion. Here in this next portion, I would like to go a little bit more into detail about what exactly the quick ratio, acid test, and current ratio and the cash ratio do. So the quick ratio acid test is liquidity ratio that measures the ability of a company to pay its current liabilities when they come due with only quick assets. Quick assets are current assets that can be converted into cash within 90 days or in a short term, hence the term that they are more liquid. The current ratio helps investors and creditors understand the liquidity of the company and how easily that company will be able to pay off its current liabilities. So the ratio expresses a firm's current debt in terms of the current assets. And the cash ratio or cash coverage ratio is a liquidity ratio that measures a firm's ability to pay off its current liabilities with only cash and cash equivalents. That's more liquid. The cash ratio is much more restrictive than the current ratio or the quick ratio because none of the other current assets can be used to pay off debt. Only cash can be used because it's so liquid. And this is why many creditors end up looking at the cash ratio because they want to see if a company maintains an adequate balance of the cash to pay off all of their current debts that are due to come. So with Delta Apparel, their cash ratio wasn't that good, so many creditors would look at that and they would probably deem that it's not adequate to pay off the debts that they are incurring based on the cash balances that they currently have. We are now going to be moving on to the leverage ratios, which include the debt ratio, the equity multiplier, debt to equity, times interest ratio, and the cash coverage ratio. So starting off with the debt ratio, the debt ratio is total assets minus total equity divided by total assets. So when you do that calculation, it's going to give you the data for the debt ratio for both companies. And for Delta Apparel, their debt ratio was higher in later years and much lower in the past years. And for the debt ratio for KBS, their debt ratio was a lot lower than Delta's. So that is definitely a good thing because they do not have as much debt. And equity multiplier is the total assets divided by the total stockholders' equity. And that ratio for Delta Apparel has a pretty stable range. It's more consistent. And for the equity multiplier for KBS, theirs was kind of ranging between 1 and falling a little bit below 0 going into the past years back in 2014. For the debt to equity ratio, debt divided by debt to equity is the total shareholders' equity divided by the total liabilities. That's going to give you the data for the debt to equity ratio. So debt for equity for Delta was 0.7 in the recent years of 2018, and then it was 0.6 back in 2014. So they've had a pretty kind of more, I would say, a consistent range. It didn't just fall too low or too high. So theirs is a little bit more consistent with their debt to equity. KBS, theirs did fall below 0 a lot in 2018. It did get a little bit higher. So they are having a range falling between 0 and it's getting definitely higher going into 2018. So the times interest ratio, that is going to be times interest earned, which is the EBIT divided by the interest expense. So for Delta Apparel, theirs was ranging from 2 to 1. They didn't have too much. They had a spike that went down to about 0.6 back in 2016. So their range kind of fluctuated a little bit. The times interest ratio for KBS, theirs did range a lot from the 2s to the 3s. So theirs was kind of going everywhere as far as their times interest earned ratio. And the cash coverage ratio for DLA did range from 3 to 1. So back in 2014, it was lower, and then as 2018 approached, they did increase over time with their cash coverage ratio. And the cash coverage ratio for KBS, it has gone from 0.9 to a lot lower back in 2014. So their cash coverage ratio is fluctuating a lot as well. The formula for cash coverage ratio is the EBIT plus depreciation divided by their interest expense. So that is everything that we had covered for the leverage ratios. And going a little bit deeper into that, the debt ratio, it does show how many assets the company must sell in order to pay off all of its liabilities. So this ratio measures the financial leverage of the company, and companies with higher levels of liability in comparison with the assets are considered highly leveraged and more risky for the lenders. The debt to equity ratio is financial liquidity ratio that compares a company's total debt to their total equity. So a higher debt to equity ratio indicates that a creditor's financing bank loans is used more than the investor financing the shareholders. So a lower debt to equity ratio usually would imply that a more financially stable business is what you're looking at. Companies with a higher debt to equity ratio are considered more risky to creditors and the investors than the companies with lower ratios. So that's pretty much how that portion of that works. And creditors view a high debt to equity ratio as risky because it shows that the investors haven't funded as much as the operations as the creditors had. So they're not putting a lot of their own money. The creditors are the ones that are investing more into their companies. So investors don't want to fund businesses that the business operation personally hasn't funded, because then that would technically mean that the company probably isn't going to be performing very well. So a lack of performance might be the reason why the company is seeking out extra debt financing in the first place. And for the times interest earned ratio, that is also called the interest coverage ratio, and it measures the proportionate amount of income that can be used to cover interest expenses in the future. Since interest payments are usually made on a long-term basis, they often are treated as ongoing as a fixed expense. So the times interest ratio is stated in numbers as opposed to percentages, and that ratio indicates how many times the company could pay interest with its before the income tax. And so obviously the larger ratios are considered to be more favorable than the smaller ratios. So as you can see, the creditors would favor a company with a much higher times interest ratio because it shows that the company can afford to pay the interest payments when they are due. So they're going to be on time with their payments, and they have more credibility as far as what they have shown in their past. So the higher ratios are less risky, while the lower ratios do indicate that they are possibly going to have a higher credit risk. Here I'm going to discuss the debt to equity ratio as far as a graphical presentation, so that I can give a visual image of how exactly this looks. So where the red and brown shaded region is where the levels of debt have occurred for DLA, and the green is where their equity has occurred over the past 6 years, from 2013 to 2019, 6 to 7 years. So their debt has definitely taken up a major portion. However, their equity is like barely covering it. So that's a big major part of this. And their cash is blue, and you can barely see the cash at the very bottom because the amount of cash that they have is very, very low compared to their debt and their equity. Now we will be looking at KBS Fashion and their debt to equity and cash analysis in a graphical representation. So for their debt, you can see where there's a red-brown region. It is very, very low. Their cash is very high. It's in the middle, but it is definitely covering their debt. Their cash flow is a lot better, and their equity is extremely high. So this graph is pretty much inverted compared to the other one for Delta Apparel. In comparison, their debt and equity are definitely pretty opposite. Next, we'll be moving on to the asset management ratios, which include inventory turnover, total asset turnover, accounts receivable turnover, and average collection cycle. So for inventory turnover, it's going to be the cost of goods sold divided by the average inventory. And so we had a lot of different ranges from 2014 to 2018 for the inventory turnover for both DLA and KBS fashion. For KBS, there's one more into the negative. For DLA, there's one more positive. Next, we'll be moving to the total asset turnover. Total asset turnover is going to be the net sales divided by the average total assets. For the total asset turnover for DLA, theirs were pretty consistent and ranged from about 1.1 to 1.2. And for the total asset turnover, theirs ranged from 0.29 to 0.87. So in recent years, they have been declining. In the past, they were a little bit higher. And next, we'll be going on to account receivable turnover. Account receivable turnover is equal to the net credit sales divided by the average accounts receivable. And theirs for Delta range from 1.92 to 1.48. So theirs we're fairly consistent. They have gotten higher in recent years. Their account receivable turnover has gone in the negative for the KBS, but theirs are also pretty consistent with staying in between 0.2 and 0.4. And we have the average collection cycle. The average collection cycle period formula is equal to accounts receivable divided by credit sales times the number of days in the year, which would be 365 days. So going into more detail about what is accounts receivable, it's an efficiency ratio, an activity ratio that measures how many times that a business can turn its account receivables into cash during a period. And in other words, the account receivable ratio does measure how many times a business can collect its average accounts receivable during the whole entire year. That's 365 days. A turn refers to each time that a company collects its average receivable. So every time there's a turn, the company has collected an accounts receivable, and the ratio shows how efficient the company is at collecting its credit sales from its customers, so how many times a customer will pay back its credit on average. Since the receivable turnover ratio is measured by a business's ability to maintain its efficiency and collect its receivables, it only makes sense that a higher ratio would be more favorable. Higher ratios do mean that the companies are collecting their receivables more frequently throughout the year, so a lower ratio would mean that they are not collecting their account receivables on the credit on account as quickly. Their time would be a lot slower. So going into the inventory turnover ratio, that is an efficiency ratio, and it's managed by comparing the cost of goods sold with the average inventory for the period. And this measures how many times the average inventory is turned or sold, and that's during that period only. So we're going to be measuring how many times the company sold its total average inventory dollar during that year. And that's covering what the inventory turnover ratio does as far as efficiency for that company and its control of the merchandise. So it's important to have a higher return. And this also does show that the company did not overspend by buying too much inventory and waste resources and possibly have to throw away old inventory. And it also shows that the company can effectively sell all of the inventory that it buys. So their they're a marketable company. And this measurement also does show investors how liquid the company is, because they're obviously selling the inventory that they purchase. So their asset turnover ratio is a efficient ratio to generate the sales, to compare the ability that they're able to generate sales from its assets by comparing the net sales with the average total assets. And it's going to show how efficiently it can use its assets to generate sales. And it also measures how liquid the firm is. So that's definitely important component for the investors and the creditors to look at as well. So higher turnover ratios mean that the company is using its assets more efficiently, and the lower ones mean that it's not using it as efficiently, which would result in issues with production because they would have an abundance of inventory and they can't sell it. The average collection period is the amount of times that it takes for a business to receive its payments owed in terms of the accounts receivable. So the average collection period is calculated by dividing the average balance of accounts receivable by the total net of the credit sales for the period, and then multiplying it by the numbers of days that are within that period. Next, we'll be moving on to the profitability ratios, which include the total profit margin, return on total assets, return on common equity, operating profit margin, and net profit margin. Starting with the total profit margin, that ratio is going to be reflected by dividing the net income divided by the revenue times 100. In this comparison, we have ranged from -1 to positive 1.4. So going from 2014 to 2018, so they have increased over time. The total profit margin for KBS has gotten higher over time. So in 2018, it's 1.94, and back in 2014, it was 0.36. So over time, they have steadily increased with their net profit margin. And the return on total assets is going to be the EBIT divided by the average total assets. And for DLA, they were operating a little bit below zero, going to 0.03 to 0.02, and the return on total assets for KBS was going into the negatives, negative 0.2 to 0.3, and that's going to be the EBIT divided by the average total assets for the return on the total assets. And for the return on common equity, it's going to be the net income divided by shareholders' equity. And that was pretty consistent across the board for both companies. Their numbers were roughly close and consistent for both parties. And for the operating profit margin, that's going to be the operating income divided by the revenue times 100. The operating profit margin was higher going into the later years into 2018 for DLA, and it was lower coming in for KBS. And the net profit margin for both companies is going to be the net income divided by the revenue. And for DLA, it was getting higher going into 2018, and it was lower for KBS going back into 2014. And so going into detail about these ratios and what they reflect, the profit margin ratio is also called the return on sales ratio, or also the gross profit ratio as well, and it measures the amount of net income earned with each dollar of sales that is generated by comparing the net income to the sales of the company. So it shows what percentages of the sales are left over after all the expenses are paid by the business. Creditors and investors use this ratio to measure how effectively the company can convert its sales into net income. Investors want to make sure that their profits are high enough to distribute dividends, while creditors want to make sure that the company has enough profits to pay back its loans. So outsiders basically want to know what the company is doing as far as how efficiently it's running before they throw their money in there. And an extremely low profit margin would indicate that the expenses are too high and the management needs to budget and cut down some expenses. And the return on sales ratio is often used by the internal management to set the performance goals for the future. And the return on assets ratio is also often called the total return for assets, and it's a profitability ratio that measures the net income produced by the total assets during a period by comparing the net income to the average on total assets. So it's going to the return on the assets ratio, or ROA, measures how efficiently the company can manage its assets to produce profits during a specific period of time. And since the company's assets' sole purpose is to generate revenues and produce profits, this ratio helps both the management and the investors within the company see how well the company can convert its investments into profits. So you can look at that ratio and the return on investments as a return on the investment for the company, since the capital assets are often the biggest investment for most companies. And in this case, the company would be investing its money into the capital assets, and the return is going to be measured in how profitable that was. So that's everything for profitability. So now we'll be evaluating the market performance for both DLA and for KBS. KBSF definitely underperformed in comparison to the US market, and they haven't been making a profit over these past 5 years. It's been negative, so it's currently not very profitable. And for Delta, their dividend yield is definitely going down, and we're unable to perform a dividend volatility check because they have not reported any payouts in the past few years. So going into more of what the earnings per share is about, it's the net income minus the dividends divided by the common shares outstanding that the company has issued out, and the shares that are outstanding from the ones that are issued. So it's called the net income per share, earning per share, and it is a market perspective ratio that measures the amount of the net income that is measured with the earning per share of the stock outstanding. So this is the money that each share of stock would receive if all of the profits were distributed to the outstanding shares by the end of the year. And the earning per shares is also a calculation to show how profitable the company is on a shareholder basis. So the larger company profits per share can be compared to a smaller company per share, but obviously the calculation is heavily influenced on how many shares are outstanding within the company. So the larger companies will have to split its earning amongst many more shares of stock compared to the smaller companies who are going to have less shares of stock. And the earning per share is the same as any profitability or market perspective ratio, whereas the higher earnings per share is always better than the lower ratio, because this means that the company is more profitable and the company has more profits to distribute to its shareholders. So a higher ratio, good; low ratio, definitely bad. And although investors don't really pay maybe too much attention to the earnings per share, a higher earnings per share ratio often makes the stock's company price rise, makes the stock price rise for the company. And a lot of different things can affect and manipulate these ratios. So it depends on particularly what those investors are looking for. So it may or may not drastically influence a decision of whether they want to invest with this company. So the overall conclusion for both KBS Fashion and for Delta Apparel is that KBS Fashion has not made a profit on their year-to-year earnings, and their growth rate is downward sloping for the past 5 years. So in order to make a comparison for their 1 to 5 year average, it's not currently profitable, and their industry grow rate is also not very currently profitable. So it's hard to establish if they have used any of their assets very well in comparison to the industry average, because at this point they're pretty much loss making, and they're going to have to get used to getting their capital together for the last 3 years, because the last 3 years it definitely has been declining. So it's currently loss making, and Delta has not used its shareholders funds in the last year. So Delta's used its assets, but it hasn't used them efficiently as far as the industry average over the last years based on the return on assets. Delta's apparel use of capital went down last year in comparison to their 3 years ago, just like KBS. And they haven't reported any payouts, so we're unable to determine if their Delta Apparel's dividends have been increasing or decreasing, because they haven't reported any payouts. So we're unable to calculate that, and their dividends are not available. So that was my project for the dew point analysis for Finance 301. Thank you so much for listening and for watching.